So we have learned on the market structure of price action. We have learned on the liquidity. We'll learn on the market making in order to narrow down areas for reversal and to know how to take good entries, because market maker method offers that.
Okay.
So we start with the pattern, the anatomy behind market maker patterns. And these are the patterns that we need to be looking for on the 15 minutes. And some patterns can also be looked for in higher time frame. M and W patterns occur in every time frame, so they can also be looked for in any other time frame. But 32 pattern is usually on the 15 minutes, to high test and low test patterns also. So let's start with the M pattern, the anatomy behind M pattern. When the dealer is forming the M pattern, simply you would see an Asian range, a tight Asian range that also rate going down. And then the dealer will be inducing people to take buy trades. And while inducing people to take buy trades, is also raiding the buy stops around here. So it's inducing people to take buys. So for the first time, it's inducing people. I'm buying, I'm still buying. Oh, I'm still buying. So people will be entering the buy orders, and we have weak traders who enter buys and put their stop loss just below the candles. So this first leg here will be an inducement to to sellers, those aggressive sellers. It will be an entry for aggressive sellers, but also stop and for weak buyers. And then he'll be inducing more buyers going long. And eventually you see the market reversing. And sometimes this second leg comes to break the first leg, and that will be a stop and for weak sellers. And eventually the market will reverse. Our entry, we wait for a crossover of 5 and 13, and the candle should close below the EMAs. So if the 50 is near, so you wait for a candle close below the 50 EMA. If it's not near, then the candle close below 5 and 13 and the crossover 5 and 13, there is the entry. So you need to be patient with it and wait for the entry confirmation. Here we have an example. We have what we call a quick M. A quick M is usually like a V. See, this is like an A top, but you can see we had the first leg here and the second leg here, and it was very quick. So a presence of a green candle here, it indicates that this was a retracement for a second leg. So that's a quick M. If you go to the 5 minutes time frame, you find a very good M formed at that particular point in time. And let's look on the W formation now. When the dealer is forming the W, first you'll be inducing people to take short trades. While it's inducing people to take short trades, you'll be opening his long orders, but also you'll be raising the sell stops around this point. After inducing sellers, we'll have a stop hunt for weak sellers who entered their orders and put their stop loss nearby. But also this is an entry for aggressive buyers. And then we would have an inducement here, more inducement to sellers, and eventually the market would reverse. So our entry is the crossover 5 and 13, a candle close above it. So here the 50 was somehow far, so you can enter here. But also this is another entry. And also this was another entry since the EMAs are here. So you need to be patient for the crossover 5 and 13 in order for you to have an entry. And we have seen that for an M formation and for a W formation, when the dealer forms these patterns, he eventually has the liquidity needs. So if an M or a W is formed in the hour 1 peak or on the daily peak, then we know that we know the anatomy behind an M formation, we know the anatomy behind a W formation. We eventually know that this indicates that the dealer has the liquidity needs, and therefore we expect for a reversal there. And here we have a quick W. See this was a W here. That is somehow rough, but we have several green and red candles, and you can clearly see a formation of a W here. And if you go to the 5 minutes, then you can see a very good W. And here we have what we call a 22 pattern. A 22 pattern is when the dealer forms the first leg and the second leg M, or first leg and second leg W. But then we have another stop and high for the third leg. This will be like the second leg of a second leg. So this is a 22 pattern here. So if you see 3 hits to the top or 3 hits to the bottom, that's simply a 22 pattern. And we have a 21 pattern, which occurs between 2 sessions. Now we have maybe around New York session, the dealer formed a W. And then we had a consolidation. And on the next day, it will come for a third leg here. We'll have a V, and then it will go. So this will be like a 21 pattern.
Mm-hmm.
So that's another pattern that can be formed in the markets. And we have a V or an A top. A V top is usually a V or a V top, or we call it an A top. It's not actually a V top. An A top is usually we can see railroad tracks when the dealer is forming this. Usually we see railroad tracks like this one. This is like a morning star pattern. It's an evening star pattern here. And you can see clear 3 swipes going up, and then the dealer forms an A top there. Our entry is simply after the crossover 5 and 13, and the candle close below it. And here we had another view. You see, there's a railroad track here, and you can see here, usually the dealer gives us like a second leg and somehow. See this one?
Yeah.
And there is our entry. See, we had all the EMAs here. So I usually wait for a candle close above it. And there is the entry, and this retest here also gives us another entry. This is a V, and this is a very clear, very good V. You can see a very clear run on the bear side and very clear run on the bull side. And our entry is right there. And we have the high test and low test patterns. These are the patterns that occur around yesterday's high or yesterday's low. But usually the dealer only pins the high or the low and forms a V out of it. Like here we had a low test pattern. The dealer came and pin, and we had a V. Here we had a low test pattern. See this pin? This was simply triggering of stop losses or the penny dollars around yesterday's low, and then eventually a reverse. See, this was a railroad track there, and then there was a W here. So this is a a low test pattern. We had another high test pattern here, where the dealer comes and touch the blue tracer, and then eventually forms a pattern there. I usually have aggressive entries during this high test and low test pattern like what we had here. But at this point, I waited for that M to be complete, and I entered. See my entries. See, the candle is below. That is why I took my entry to sell the last minute of this candle.
Okay.
So the most important aspect when trading this M's and W is your entry. You can and will start to get good trades with zero drawdown if you keep practicing patience. So let price come to you. You need to wait for the M to complete, for the W to complete. Unless you are having you're over trading, you're over leveraging your account, you should never feel like your emotions will get the best of you when trading, because if you are correct in the direction of the analysis, and if your direction bias is right, then even if your M or a W has moved quite a number of pips, because sometimes you have shift candles.
Yes.
See, if your direction is right, price will eventually rise, and it will be a zero drawdown trend. So you need not to fear. See, M's and W's setups are designed to be executed with precision and accuracy to help you achieve the best possible risk-reward ratio. Because when a W is formed and the market moves up, then right here we have the low of the day. So you're entering your buys on the lowest possible point of the day. So your risk, your stop loss will be below here. And when you are having an M, this will be the high of the day. So you're entering yourself at the highest point of the day. So your risk will be just above it, your stop loss. And you have more potential for reward, because the profit release stage I would guarantee you the ADR or your target 50 or 70 pips. So you have a small stop loss and a more potential for reward. And we usually expect that the dealer should work out the high or the low of the day for at least 1 hour and 15 minutes. So when the dealer is forming an M or a W, it's where he's setting the low or the high of the day. So it's where he's setting the high of the day or the low of the day. So we expect for the dealer to work around that for at least 1 hour and 45 minutes. And that means a good M or a good W has at least 7-15 minutes candle. So a good M or a good W has at least 7-15 minutes candle. That simply means 1 hour is 4 candles and 45 minutes is 3 candles, so there's 7 candles. And we usually start with the candle going down and the candle coming up. So to count the candles for a good M or a good W. But once you go to your previous charts and mark as many patterns as possible, you can simply see a good M or a good W with a blink of an eye. As it's happening, you can simply see it happening. Like this is a good M, this is a good W, and you take it. We have the we have the we have the anatomy of the Asian box. Previously on the part of liquidity, we have learned on the power of three, and there we learned on the accumulation phase, the stop and or the Julia swing, and a pattern formation on the three intraday levels. Now the accumulation phase, we expect that the Asian box to have at least at most 50 pips. So our Asian range should be less than 50 pips, and any Asian range having greater number of pip range is said to be blown and not good to form a strong London pattern. But with experience, you can simply trade even the blown Asian range. When the Asian range is tight, we have the London patterns that we usually look for. And these London patterns are usually based on safety trends. We have the type 1 London pattern, where we have our tight Asian range. And in type 1 London pattern is where the dealer breaks the initial high or the initial low of the day that he has set. So we would have a stop and above or below the Asian open. Above or below the Asian close. We have a stop and the pattern will be formed there. And from this structure, you see the pattern is formed around session changeover, but it's not usually that way in the real market. Sometimes it may happen, sometimes it may not. But the main key points that we need to learn here is that this stop and breaks the initial high, and this stop and did break the initial low of the day, and then the dealer will set the high and the low of the days. And for the type 2 London patterns, these are the patterns that you simply see that the dealer is maintaining the high and is maintaining the low, and the initial high or the initial low of the day. And this pattern forms around the Asian high or the Asian low. And this usually happens when we have an uptrend. Yesterday we had an uptrend here, and the dealer had started its stop and here, and then we have Asian range there, so the dealer doesn't have to go for another stop and then you see eventually the dealer is moving up. And here this stop and will be around New York previous day New York low, because for that stop and will be around New York, and you have previous day New York low at this point, so you'll be maintaining that. And we have the type 3 London pattern, where we see that the dealer would be forming a pattern around Asian mid-range. On the previous templates, we had the Asian midline there, but the 50 EMA is usually around there. So you simply see a bounce around the 50 EMA for a 50-50 bounce trade. And that will be a type 3 London pattern. Usually it occurs after an EMA combo on the previous day. So those are the three types of patterns that we usually look for in the market. And we have now we have the market maker cycle, the basics. Market maker cycle is the key in trading market maker method. You understand the cycle, then you already understood the market maker method. So the market is based on a 3-level cycle, not a 3-day cycle, but a 3-level cycle. So before the dealer moves, market maker will set a peak formation high to be the highest or a peak formation low. And then you see three levels of rise. And at each level, you see a corresponding level of consolidation. So this is level one, see a corresponding level of consolidation, stop and towards the peak. And then this will be level two. We'll see a corresponding level of consolidation, stop and towards the peak. And that will be level three. And the same will be for a downtrend. See level one, corresponding level of consolidation, stop and towards the peak, level two, and level three. If we say the cycle is a 3-day cycle, I mean the market is based on a 3-day cycle, then we simply count these days that the market had moved. So this will be day one, this will be day two, and this will be day three. And that's where the 3-day cycle came in. So at each level, you need to see a corresponding level of consolidation. And during this consolidation, market makers will be triggering stop losses before moving to the next level. So the market makers will be grabbing extra liquidity for the next level move. And usually level one is market maker driven. It's very fast because you see the market makers have entered their sell orders there. So it's usually very fast and catches the retail traders surprised because they were seeing that the uptrend momentum is big, and now the market has suddenly reversed. Level two is usually driven by emotional traders. It's usually rough, and then you see the dealer's hand in level three. Because level three, you see the market moving fast, and there is where the dealer will be using retailers to enter shorts. So you'll be triggering stops and creating panic, and eventually the market makers will apply the brakes, and then the market will reverse. And we usually look at the three levels and three times ADR as a completion of the cycle. So we know that the cycle is complete when we see three levels and three times ADR. So for example, here we have this is USD. So you can clearly see here we had peak formation high. We had level one of drop, level two of drop, and see each level corresponded with the ADR. With the ADR boxes, and level two had a greater consolidation since we had the week beginning here. So Monday going Tuesday false move, and then we can clearly see that the dealer has not completed the three times ADR, and you cannot see the third level. See, it did not break this low that it has formed here. So you need to be to see that it has broken this in order to count that as a level. And for the benefit of others who will be for the benefit of others who would watch this video in later times, let us learn on how to draw the ADR boxes. So before drawing your ADR boxes, you need to identify your peak. So this is the peak here, and you'll learn on how to identify these peaks. And from this peak now, we had this is the lowest point price has reached. This is where I start drawing my rectangle. So you take the rectangle tool and The properties for this rectangle should uncheck this box, and now our ADR times 1 is around 3099. So as I move this box, I find that see numbers will be showing there is 3789.8. So I'll be finding 3099.9. So 30. So ADR is simply an average. So around that is a good point to plot. ADR is simply an average of 15 days for the number of pips moved. So I hold control button and I form a duplicate to this in the mouse. So that's second ADR, and that's the third ADR. So clearly this was a peak formation high, but also we were anticipating for a peak reset here, come to learn. So from this point, you need to draw other 3 times ADR boxes going up. So we look at a completion of 3 times ADR and the 3 levels cycle as a complete market maker cycle. And sometimes the levels cannot be seen clearly. So the ADR boxes will help you to identify that now this cycle is complete. Sometimes the dealer has enough liquidity, doesn't need to retrace, and the dealer eventually moves without retracement, without forming clear levels. And during news release, we usually look at the cycle, and the dealer always follows the cycle. So you need to know where you are in the cycle, and you anticipate on where the direction of news is. And we usually use the index, for the respective currency. They're found in right Forex broker. So this was the dollar, and this was forming. You can see the dealer completed the third level using the news. So the dealer simply completes the cycle using the news. So level three is somehow rough because at this point, the dealer expects that we expect the market to reverse. So the dealer has to grab the liquidity needs for the market to have a swing reversal. So you'll see price dropping or rising a bit further to demonstrate further bullish, further bearish movement, which will satisfy various criteria for retailers. And there is where they enter their trades in the wrong direction. And eventually the market maker will pull away quickly and moving away price and book a profit. So level 3 will appear disorganized, see price chopping back and forth, usually within a wide range. And we know that when traders lose money, they take a day off to reevaluate. So I expect for level 3 consolidation to be around 2+ days in order for the dealer to chop around for those retailers to come back and enter again back into the fray and the cycle to continue. And that's how the dealer works. And this was an example for a level 3 behavior. We had our completion in the cycle was here. So first, market maker came to bounce to this point, and then we see further bearish move. You can see 3 levels going down. So those further bearish move indicates that the market makers are using people to take shorts, and eventually market makers apply the brakes and then reversed. And you can see here from this day to this to this to this. These are like 4 days of consolidation. and you see price bouncing around the EMAs, will come to talk of the trend, and you can clearly understand why the dealer will be bouncing around these EMAs. This is to satisfy for the retailers to enter shorts. And even those who have drawn the trend line, you may clearly see that it will be bouncing around this trend line. Now, after the cycle is complete in the hour and time frame, you should expect one of the following. First of all, we should expect for a reversal. That's the first thing that we should expect. And second, we should expect for price extension. And the third is a peak reset. Now let's talk of reversals. When price reverse direction, it simply indicates that market makers have run a level of stops and a significant move should unfold in the new direction. Now, we should expect for a reversal when the market is consolidating. So what should we look for in price after the cycle is complete? We should look for a peak formation low or a peak formation high. And after the peak is formed, we should be looking for liquidity pools just above or an old high or below an old low. So this was a consolidation peak here. You can clearly see after the cycle was complete, we had a consolidation up here, and eventually the market reversed. So your first target after the reversal will be the next area of liquidity pool. So the next area below this low. So below this low, here is an area of liquidity pool. And this retracement here would give you the next area of liquidity pool just down here. And that will be the second target and the third target. We'll come to learn on how to identify these peaks. And we'll know how the dealer grabs liquidity with several kinds of peaks. And here we have price extension. Usually, we say that when the dealer is in level 3, we expect for price to be extended further to satisfy various criteria for retailers. And usually price extension have targets based on higher time frame. For example, for this flashcard here, we had Euro USD completing the cycle around this quarter here. But then the dealer had a target to reach this major quarter here. This was a large quarter point, and eventually did raid the stop process below it and reversed. So we had a good consolidation peak up here, and here we had a very good price extension. And usually this price extension goes to the quarter points, goes to the EMAs, high time frame EMAs, the 200, the 800 EMA. And now let's talk of the peak reset. A peak reset. How do we define peak reset? We have a cycle. And we have another peak formation low here. And the dealer moved. And the dealer forms another peak here, which is on the same direction as the previous peak, as the previous cycle that has just completed. And you see other 3 levels going down. Now this is what we call a peak reset. So a peak reset is a peak formed as a continuation of a previous cycle. Meanwhile, the recent cycle is not complete. So this newly formed cycle here will be moving around 1.5 ADR, and then peak reset presents itself. And peak resets can be easily anticipated and confirmed as a retracement on the daily time frame. Because on the daily, let's now talk of the daily structure. On the daily, we usually have peaks, 3 levels, again peaks, 3 levels, again peaks, 3 levels. And also resets occur on the daily. Like you see your peak, you see the dealer has moved 2 levels and he has reached 200 EMA, formed a very beautiful W there, and then reversed. So here we have an example. We had a peak here. This was a very good W as a peak. We had level 1, level 2, level 3. And the dealer formed a consolidation peak here. And you can see clear level 1, level 2, level 3. But since now, the market structure for Euro USD was bearish based on the weekly and the monthly time frame, we had an extension. This was a peak extension, but also a level 3 behavior. But you can see, you can clearly see how choppy it is going down. Now, when you see that the dealer has formed a peak on the daily, you should expect for 3 levels on the daily, and that means 2 peak resets on the hour 1 time frame. And our first reset usually occurs on the daily. We see a 5 and 13 crossover and a retracement. Now the first retracement goes all the way to the 13 EMA, and for this peak reset we had also the 50 EMA around it. So our first peak reset will be around the 13 EMA. Our second peak reset will be around the 50 EMA, and usually for the first and second level indicates that price has moved further from the peak. So the dealer has enough ground to for a stop and for a retracement. And usually this retracement from this point to this point, usually it completes the 3 times ADR. But this retracement here for the first level usually completes only 1.5 times ADR. And this is our second peak reset, and usually occur around the 50 MA on the daily or a quarter point on the daily. And then we see a clear cycle. This was a cycle on the hour 1, and it actually had an extension. It actually had an extension. And then here we had the dealer forming a peak, but then it came to grab the liquidity down there. And so you can see this peak here that it did form was not like this one, huh? Because this was a stop rate, so he had the liquidity in his zone. So we saw 3 levels going up, and then we had another peak there. So the daily structure is very important for a market maker trader in order for you to identify these peak resets and know where you are on the cycle based on the daily. And this is see this daily cycle here. How is it seen on the hour 1 time frame? On the hour 1 is seen like this. So we had our peak formation low down here, a very good head and shoulder pattern, shoulder, head. And we had clear 3 levels going up. We had a peak formation high, moved all the way to this. Usually the peak resets occur around 200 EMA. And we had the peak reset also around the quarter. And then we had a peak reset there. 3 levels were seen. And then we had a peak formation high. And we had like 2 levels going down. And here we had a news peak. I remember this news peak, and it was around the quarter point and the 200 EMA. And we can see here 3 levels were seen. And here is where it formed that big M on the daily. So this is a wider view, and this is USD card, a very good peak layers were formed on USD CAD. Here we had consolidation, about a month consolidation, and then the dealer came to grab liquidity up here. When you come to learn of the seasonal move, this was the last move before a seasonal shift. This year was the last move, and usually on the hour one is a complete cycle. And then from there, the dealer formed a peak. We had a first level retracement, second level. See this retracement now. Now, sometimes the dealer has what we call the quick reset. So long as you know the view on the hour and time, on the daily time frame, and you see that the dealer has shown a reversal around 13 EMA, around the 5 EMA. And on the hour one, you see that the reversal is around the 50 EMA. That simply means it's a quick reset. And you simply see another cycle going down. And you see from this point here, the dealer now formed a peak low. See breaking several lows here to grab the liquidity, and we had clear 3 levels going up. And then we had choppy market, formed an M here. We had 3 levels going down, we had 3 levels going up. So the daily time frame, I usually use the daily time frame more than our own time frame, because higher time frame buyers will give you high probability setups in the lower time frame. So here you have a peak formation low, and this was completed using the news. We had a peak formation high, we had a peak reset here. We had 3 levels going up, we had a peak formation high. At this point, we see 3 levels going down to the 800 EMA, which is the same as the 50, and then another cycle was formed. So for the cycle, for the how one cycle to be fully understood, you need to have your bias based on the daily time frame. And never confuse levels with Elliott waves. And I will finish up with the EMAs for today. Exponential moving averages. We have indicators that are thrown to our discretion in order for us to easily identify these market sentiments that we just learned. And we have the exponential moving average. EMAs, when used in the appropriate way and control, they can give a true reading of market direction, a reading of market momentum. They can give entries, they can give us entries, they can give us exit points. And also in our time frame, they can be used as moving support and resistance points. Mind you that the moving average are mathematical calculated indicators, and they usually feed in several candles to the model in order to predict the direction for the next move. So if you see an EMA with a period of 5, that means it feeds in its model previous 5 candles to the direction of previous 5 candles to know the direction of the next candle. So you see that the master usually moves along in the market because it's usually feeds in a few number of candles, and the ketchup follows the 13 EMA, which is red in color. We have the water, the 50 EMA, which feeds in 50 candles. We have the 200 EMA, we have the blueberry, and we have the 3200 EMA, the medium violet red. And the blueberry and the 3200 EMA, usually they're like flat EMAs in higher time frame, because in order for them to reverse, to show that now this is a reversal, you see a lot of candles need to be filled in, and 800 candles that maybe are going uptrend shows that now this is an uptrend for the blueberry. and for the medium volt, it's around 3,200 candles. So the first thing that you need to understand is the EMA conversion. The position of the EMAs in higher time frame can give you a position of a certain EMA in the lower time frame. As you go lower in time frame, you simply multiply by 4. Like if you see the 50 EMA in the hour 4 time frame, the position of 50 EMA on the hour 4 is the same as the position of 200 EMA on the hour 1. So 50 times 4 is the same as the 200 EMA. I mean, it's the same as the 800 EMA on the 15 minutes time frame. So as you go down, you multiply by 4, and vice versa. As you go up, you divide by 4. So the 50 EMA on the hour 1 is the same as the 200 EMA on the 15 minutes time frame. The 3,200 EMA on the 15 minutes will be the same as the 800 EMA on the hour 1. So I simply added the 3,200 to fill in this gap here. Like it will be like the 3,200 EMA. And we usually use it to, for the peaks. And now let's go to the uses of these EMAs. The uses depends on time frame. On the 15 minutes time frame, we use the 5 and 13 crossover as entry confirmation. 50 and 200 crossover is usually the level 1 lock. So we should expect level 2 after that, after 50 and 200 crossover. The 50 EMA, we use it to take ID 50 trade and 50-50 bounce trade. The 200 EMA is used to take safety trade. Safety trade usually occur around 200 EMA and 200 bounce trades. And the 800 EMA is usually used to take blueberry trades and is an area for peak reset, because the 13 EMA on the daily time frame, when you come back, to be like the 50 on the hour 4, the 200 on the hour 1, the 800 on the 15 minutes. So 800 EMA is where we take peak resets off. And we have the 3,200 EMA on the 15 minutes time frame is what we take the EMA peak, because it's the same as the blueberry on the hour 1, and we have the EMA peak on the hour 1. On the hour 1 time frame now, the 13 and 50 crossover after the peak formation and level 1 has moved, it indicates level 1 lock. 50 and 200 crossover after level 2 indicates level 2 lock. When the EMAs are fanned out, it indicates level 3. So if the market maker Seiko is in level 3 and you see the EMAs have fanned out, see they are separated from each other, then that indicates that now this is level 3. And the 200 EMA on the hour 1 simply is an area where peak resets occur. The 800 EMA is an area where peaks occur, and we call it EMA peak. In higher time frame, we use the EMAs with higher periods as moving support and resistance points. Usually these are targets. When you see a peak extension, like price extending after the cycle is complete, these are usually the targets: 200, 800, and 3,000, 200 EMA. And we have the blue tracer. The blue tracer marks yesterday's high and yesterday's low. So basically they mark natural support and resistance points. Uses of blue tracer, we usually take peak trades using the blue tracer. I'll come to talk of that very well. And a break and a retest of the blue tracer also gives us an entry. And we also have the high test and low test patterns. See here we have a blue tracer trade. Here we had a blue tracer trade. The stop punch was towards the previous day low, and then the market eventually moved. And here we had a break and retest around the blue tracer. And I had an entry here after these retest here. I had an entry. We have what we call the high low drill. The high low drill is when you take an entry in the wrong side of the cycle. Like the cycle is going up, and you see an entry around the blue tracer, like here. You take your short. See the market going up, offering another entry, you take your short. But within 2 to 3 hours, you're not in significant profit, and the market is simply consolidating there. That indicates that the dealer is only using people to take the wrong direction of the trend, and the cycle is still going up. So sometimes you may enter at the wrong direction of the trend, and if you enter, suppose if you enter here around the blue tracer, and you know that the cycle is up, your target should be the 200 EMA. Usually it falls to the 200 EMA. Those are the short-term trades that you can take. And the high test and low test patterns, usually your first target should be the 200 EMA. And if the cycle is on that direction, then you can simply take more pips in that direction. We have the color coded session, which shows the sessions. We have the TDI, Traders Dynamic Index. I usually use the TDI in hour for time frame only. I'll be back in two minutes. The TDI. So here are the parts of the TDI, and I usually use the TDI on the hour for time frame. We have the level extreme high, just like the RSI. So the level extreme high is a 80 level high is 70 level low is 30, and level extreme low is around 20. We have the volatility bands, the blue bands here. We have the RSI price line, the black line. We have the signal line, the red line, and we have the market baseline. But we also have the level middle. The level middle is the level middle is the 50. Is the 50 level. You see, the market baseline is a linear weighted moving average with a period of 50. It's a moving 50, we can say that. Like it moves along with the markets. This level 50, this level middle is a stagnant 50, but this linear weighted with the period of 50, the market baseline, it's usually a moving 50. So it usually plays a role as the level middle. Okay, so now that we know the parts of the indicator, how to use it now. I usually look on the TDI when it's at extreme levels. When it's on extreme high, we know that it's a bullish divergence. We expect sales from there. When it's on extreme low, we know that's bearish divergence. We expect for the market to buy. So it's an oversold area, it's an overbought area. And I usually look for shark fin. See the RSI price line crossing the volatility bands and then coming back. And this is one of the conflicts that the dealer is now forming a peak. When this occurs around a peak formation low or around a peak formation high, then it indicates that the dealer is now forming a peak. And we have now peak resets. Usually peak resets have a shark fin around the 50 or the market baseline. So see, this is a peak reset because it has not reached the level extreme. And usually the TDI can also be used to count levels, but that is what I don't use it for nowadays. See, from this point, we first had a shark fin here. And this was a peak extension. Usually a peak extension is like this. And then we had levels going up. And then we had an M here. We had level 1, level 2, and level 3. We had level 1, level 2, and level 3. This was like a head and shoulder pattern. We had levels down here. So the R4 TDI can also be used to count levels based on the hour time frame. And this was a clear flashcard having the levels here. You can see 3 levels going down, 3 levels going down. And see, this was a peak extension here, going all the way low to touch the extreme low. And we have the harmonic patterns. Let us end here for today. We'll continue again tomorrow. And tomorrow we'll finish up this. Yes, we'll finish up this market maker series. Because tomorrow we'll learn on the peaks and the trades, and the next day we will have the quarter theory, I think. So tomorrow
Okay,
will
boss.
be.
Okay, I have a bit of a question as
Yes.
regards to the EMA.
Yes.
I've always had I don't know, maybe analysis paralysis or maybe fear when the 800 EMA, the price action is under the 800 EMA and at the same time is below the 200 EMA. So I'm like, do I wait till I'm very, very comfortable if both the 200 and 800, just like the previous chart you just showed, is above the Asian box or above the price action. But sometimes I see where the price action, the two EMAs are, like the price action is in between those two EMAs and they're very powerful. So how does one really like?
We have talked of the daily cycle, right?
Yes.
Now you need to do homework based on the daily cycle, and that fear of price action around those EMAs will eventually go away. That is what I promise you, because the daily cycle will give you a view of why is that happening. Okay.
Okay.
You simply see now that the dealer is in level 2, maybe going to level 3, and you simply see it roaming around the 200 and 800, and to me it's a very powerful confluence when I see prices around the 200 and 800 on the hour.
Yeah,
it's a very powerful confluence to me.
Okay. So on the hourly, we that's where we get our 3-level cycle.
On the hourly.
Yeah, you are mentioning the daily cycle. So I was
on the daily cycle, we see that there are 3 levels of rise, 3 levels of fall.
So drop.
And 3
Okay.
levels of rise means that 2 peak resets would occur on the hour 1, and even more.
Oh,
Yes.
okay. Okay. I see. Okay. And this, the EMA, it can also be applied to indices like Nasdaq.
Yes. But you see, when you're trading Nasdaq, Nasdaq has a certain characteristics of going up.
Yeah.
So when you're trading Nasdaq, you need to be a bit careful there.
Okay.
I need to go back to that area of reset. Yeah, this. See, I usually want people to understand on resets here. See, let's go to Euro USD. I want to show you something. See, from this peak here, from this peak we had the first level, we had a retracement. See, it did pin there, it did form this retracement was around the 13 EMA. When you go to the hour one, it's around the 200 and the 800 EMA, because the 50 is around there also. So this gives us what? Our first peak reset. And this is our second level on the daily. You see our second level there? And you see our retracement. So on the hour one, this was a peak formation low. This was also a peak formation low. So you take your entries to this EMA here. This will also be our peak. And this will be around the 800 EMA on the hour one. And we had a complete cycle. And when you reach the previous low here, which was the peak formation low, dealer induced people to go short and eventually reversed. And we now know that the dealer has completed 3 levels on the daily. We're expecting for a reversal, but the dealer came to this point, also formed a peak reset. This was the 4th peak reset to induce people to go short and eventually reversed here. So the daily cycle, when the daily cycle is continuing, you see several peak resets on the hour one.
Okay.
Okay. So we have Swiss franc news in about 4 minutes. And this is what the chef index is giving us. You see from the daily time frame. See, this was a complete cycle of the daily. And here we had a reversal. So we had level 1. See, the retracement came all the way to the 13 EMA. See this reversal. It's a very good reversal pattern. And on the hour one now, it's around 200 EMA. See, the 800 is here, but I do not fear. So my anticipation is for it to go long, to continue up. And even the COT, the number of orders for going long was increased from the last week's COT report. So let us watch on the news. So we'll meet again tomorrow at 8, okay?
Okay, same time.
Yeah.
Okay.